All right, listen, we need to talk about what just happened in the last 48 hours, because this is not your typical market correction. Silver crashed from $121 down to $74. That's a $47 move. If you're holding 1,000 ounces of physical silver, you just watched $47,000 evaporate. Gold fell from $5,300 down to $4,745. That's over $500 gone in 2 trading sessions. But here's what mainstream media isn't telling you. This wasn't random. This wasn't retail panic. And the timing of JPMorgan closing their massive silver short position at exactly $78, that's not coincidence. That's calculated. I'm going to show you why the same analysts who predicted this crash are now flipping bullish, and what this means for anyone holding precious metals right now. Let me break down the 3 things that converged in the last 48 hours. First, Kevin Warsh got nominated as the next Federal Reserve Chair on January 30th. The market interpreted this as Fed independence being preserved. Less inflation fear means less safe haven demand. Gold and silver got hit immediately. Within hours, silver dropped from $117 to $95. That's an 18% move before most Americans even woke up. Second, the US dollar index surged. When the dollar strengthens, precious metals priced in dollars become more expensive for international buyers. China, India, the Middle East, they all stepped back. Demand dried up exactly when leveraged speculators needed buyers. Physical premiums are spiking right now because actual metal is tight, but paper contracts got destroyed. Third, margin calls cascaded across COMEX. This is the critical part. When silver broke below $110, stop losses triggered. Funds holding leverage positions got margin calls. They had to sell. That selling pushed prices lower. More stop losses hit. More margin calls. The AGQ ETF, that's the 2 times leveraged silver fund, it lost 65% in one session. Retail investors using leverage got completely wiped out. Now here's where this gets interesting. According to COMEX data released this week, JPMorgan closed their short silver position at approximately $78 per ounce. Let me say that again. JPMorgan, one of the largest players in the silver market, exited their short at $78. Silver crashed from $121 down to $74. It bottomed at $74. Then it bounced back to $78 and settled there. JPMorgan covered right at that level. I pulled up the technical charts this morning. Silver opened January 30th at $117. By noon Eastern Time, it was at $95. By market close, $78. The 50-day moving average for silver sits at $82. We tested it, broke below it briefly, then recovered. That level at $78 to $80 is now the battleground. Here's why this matters. When a major institution like JPMorgan closes a short position, they're buying. They're buying when everyone else is panic selling. They're buying at $78 after riding the position down from $121. That's a $43 profit per ounce on the short. But more importantly, they're now positioned for the next move up. The volume on January 30th was the highest we've seen since March 2020. This tells me this wasn't low liquidity panic. Real buyers and real sellers took massive positions. Smart money moved. Now let's talk fundamentals, because the narrative you're hearing doesn't match the supply and demand reality. Global silver demand hit 1.3 billion ounces in 2025. That's up 7% year over year. This is being driven by 3 sectors. Solar panel installations added 140 million ounces of demand. Electric vehicle production needs 60 million ounces annually, and that number's climbing. Defense contractors ramped up silver use for electronics and missile guidance systems, another 30 million ounces. On the supply side, global mine production was 980 million ounces last year. Total demand was 1.3 billion. That's a deficit of 320 million ounces per year. This deficit has to come from somewhere. It comes from above-ground stockpiles, recycling, and investor selling. Here's the critical part. About 70% of silver comes as a byproduct of copper, zinc, and lead mining. When those base metal operations slow down because of economic concerns, which is happening now with China's slowdown, silver supply gets squeezed even tighter. We're not opening new primary silver mines fast enough to offset declining byproduct supply. Now, China's 10-year bond yield just hit 1.8% this week. That's near the lowest in over a month. This signals monetary easing is coming. When China eases, industrial metals demand typically increases within 3 to 6 months. Silver benefits from both its industrial use and its monetary role. Here's what they're not showing on CNBC. Central bank gold purchases hit 800 tons in 2025, according to the World Gold Council. That's the second highest on record. Russia's central bank added gold for 18 straight months through December. Turkey increased holdings by 120 tons despite economic pressure. These aren't short-term traders. These are sovereign nations diversifying away from dollar assets for geopolitical reasons. But here's what today's move revealed about institutional positioning. According to Bloomberg data, silver ETF outflows were approximately 50 million ounces this week. During silver's rally from $45 in October to $121 in late January, fund holdings grew by 80 million ounces. So funds still hold a net 30 million ounce long position, even after this week's panic selling. The big money is still significantly long. They're not out. They reduced exposure, took profits, but they didn't flip bearish. I want to share something George Heppel from BMO Capital Markets said on CNBC yesterday. He called this an understandable correction after an unsustainable parabolic move. He specifically noted that the fundamentals supporting precious metals haven't changed. The correction was technical, not fundamental. And here's the other side. Mining companies. Producers are not panicking. They're locking in forward sales at current prices around $80 for silver. Compare that to where we crashed. They see value here. They're not waiting for lower prices. They're securing revenue at these levels. Speculators reduced net long positions by 42% in the week ending January 28th, according to CFTC data. They still hold 68,000 net long contracts. For context, at the peak in January 2011 when silver hit $49, net longs were at 95,000 contracts. We're not at extremes yet. Today flushed out weak hands and overleveraged speculators. What remains are long-term holders and value buyers who see $80 as opportunity, not risk. We've seen this exact pattern before. Back in September 2011, silver experienced something remarkably similar to what we're seeing now. Stage 1, the parabolic rise. Silver rallied from $18 in August 2010 to $49 by April 2011. That's a 172% move in 8 months. It was driven by QE2 money printing, sovereign debt fears in Europe, and retail investor mania. Sound familiar? Silver just moved 158%, from $45 in October to $121 in January. Same parabolic shape, same retail excitement. Stage 2, the liquidation event. On May 1, 2011, CME Group raised margin requirements on silver futures. The price crashed from $49 to $33 in 4 days. That's 33%. Leveraged traders got destroyed. The media declared the silver bubble had popped. Compare that to last week. We just saw 31% from 121 to 74 in 2 days. Almost identical percentage. Almost identical forced liquidation dynamic. Stage 3, the recovery attempt. Silver recovered to $43 by August 2011. It regained 23% over 3 months. Physical buyers stepped in around $35, seeing value. Momentum traders re-entered thinking the worst was over. Right now in 2026, I believe we're entering stage 3. Smart money analysts who called the top are now saying $78 to $80 looks like a technical bottom. Stage 4, the extended bear. In September 2011, during the European debt crisis intensification, silver made its final capitulation move from $43 down to $26. It was driven by forced fund redemptions and systematic risk-off positioning. The complete journey from 2011, silver went from $18 to $49 to $26. That's a net 44% gain over the full cycle despite the crashes. Where we are now. Right now, in 2026, I believe we're between stage 2 and stage 3. Based on historical timing, it took 3 months to go from the crash low to the recovery high in 2011. That puts our expected window somewhere between late February and April 2026. If this plays out proportionally, the 2011 pattern recovered 69% from the crash low. The equivalent today would be 69% from $74, reaching $125. Conservative estimate, 40 to 50% recovery would put us at $104 to $111. But here's the key difference. In 2011, global silver mine production was 760 million ounces, and demand was 1 billion ounces. That's a 240 million ounce deficit. Today, production is 980 million, and demand is 1.3 billion. That's a 320 million ounce deficit, 33% larger than 2011. This works in favor of bulls because the structural deficit is worse. However, 2011 didn't have the industrial revolution in solar and EVs that we're seeing now. Electric vehicle production in 2011 was negligible. Solar installations were a fraction of today's scale. Today's demand has a structural, industrial component that didn't exist back then. The pattern doesn't repeat exactly, but the sequence and psychology remain remarkably similar. Let me make this personal. Let's talk about what this actually means in real dollars for your situation. If you're holding silver, here's what happened to you. On a $10,000 position in physical silver at $120 per ounce, you owned about 83 ounces. At $78, That position is worth $6,474. You're down $3,526 in 48 hours. Now, if silver drops to $70, which some analysts think could happen if we get another liquidation wave, your $10,000 becomes $5,810. That's $4,190 gone. The contrast is important here. Those who positioned correctly, who accumulated physical metal between $40 and $60 last year before the rally, their situation looks very different. They bought at $50 average. Even at today's $78, they're up 56%. They weathered a $47 crash, and they're still profitable. Smart money saw this coming. Russia increased gold reserves for 18 straight months ending December. China hasn't reported official purchases recently, but imports through Hong Kong jumped 23% in the fourth quarter. They positioned when gold was below $2,900, back when sentiment was terrible and everyone was calling for lower prices. Here's why I'm telling you this. The window is narrowing. Not because I know $78 is the bottom. I don't. Nobody does. We might go to 70 or 65 first. The structural supply deficit is real. The industrial demand is locked in. Every solar panel, every EV battery system, every 5G antenna removes silver permanently from available supply. This isn't speculative inventory sitting in a warehouse waiting to flood back into the market. It's physical metal in an installed system for 20 to 30 years. I've been tracking precious metals markets since 2008, and I've never seen COMEX registered silver inventories this tight, while industrial demand is this strong simultaneously. Registered silver at COMEX is 105 million ounces as of January 30th. During the last major rally in 2020 to 2021, registered stocks were over 180 million ounces. We're 41% lower on available deliverable metal. Look, the question isn't whether we see more volatility or crashes happen. The data shows structural deficit. The math shows demand exceeding supply by 320 million ounces annually. The pattern shows forced liquidations create bottoms that smart money buys. The real question is, are you positioned for what comes next? In every previous liquidation event, physical metals preserved purchasing power while over-leveraged paper positions collapsed. We just watched that play out in real time. AGQ ETF holders lost 65%. Physical holders who didn't panic are down temporarily, but still own the same ounces. Right now, silver sits at $78 to $86 depending on the contract and exchange. The February COMEX contract is at $78. The key technical level to watch is $82. That's the 50-day moving average. If we reclaim that level and hold it through next week, it confirms buyers are defending this range. If it breaks and we go below $75, the next major support I'm watching is $68 based on the October 2025 breakout level. I share real-time updates and deeper analysis on social media. For those wanting exclusive research and early warnings before major moves, there's a premium level where I break down institutional positioning data and technical setups as they develop. Legal disclaimer. This is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations. But the structural deficit, the institutional positioning we just witnessed with JPMorgan covering at $78, and the fact that analysts who called the crash are now flipping bullish tells the story. The data speaks for itself. All right, before you go, 3 quick things. 1. Drop a comment below. Tell me where you're watching from, and give me your prediction. Where do you think silver is headed by end of February? Are we going back to $100 or dropping to $65? 2. If you're not subscribed, hit that button now. I'm putting out unfiltered analysis multiple times per week, breaking down exactly what smart money is doing while mainstream media feeds you the narrative they want you to believe. And listen, I'm fighting copycat channels stealing this content and re-uploading it with different voices. If this video provided value, if you got something from this breakdown, comment data over hype, so the algorithm knows you're here for original research, not recycled talking points. 3. Next video drops tomorrow morning. I'm covering the one technical indicator that predicted both the 2008 financial crisis and the 2020 COVID crash. It's flashing again right now, and 99% of traders aren't watching it. Last time this signal appeared, silver moved 43% in the following 6 weeks. You won't want to miss it. See you there.